Stock snap a 3-day loss after, well, pretty good jobs data. Got some positive signs from manufacturing, and FedEx delivers on their numbers. Will it continue? Do you dive in? We bring in Mark Lamkin. He's the CEO of Lamkin Wealth Management. It's an investment advisory firm out of Louisville, Kentucky. Thanks for coming on, Mark. Appreciate it. So do you go here? I mean, do you like the trend? Do you buy into the Santa Claus rally with what's left of the year, or do you stay the heck out?
You know, in our models, we're about 50% invested. I don't think there's a big trend to play here. Recently, it seems like a death by 1,000 paper cuts because Europe is just simply not moving fast enough. I mean, we've got decent U.S. economic data, but it's not offsetting the uncertainty in Europe, and it's caused me to stay on the sidelines with at least 50% of the portfolios.
So we say, you know, we snap a 3-day losing streak. We're still down on the week. We're still down on the month. We're still down on the year.
Right. Yeah, and I tell you, it's going to take the ECB stepping up and doing some type of QE, quantitative easing, or some type of TARP program. That happens, monster Santa Claus rally, great January effect. But without that, it's going to be modest at best.
And so if you're being active, where's your active money going right now?
Well, we like things that aren't going to be impacted by Europe per se. I like U.S. technology right now. I think they're cash rich. They're helping other companies become more productive, more efficient. Don't have a lot of exposure to commodities. We're actively buying technology right now. And U.S. consumers right now. I like the consumer. Consumer sentiment's getting better. Retail sales up. Not necessarily impacted by Europe. Those are two areas that we're putting money to work right now.
So the discretionary side of the consumer, not the staples?
Yes, the discretionary side. And, you know, and let's face it, yield is a good play right here in the trendless market. When you look at the Barclays High Yield Index, I can get 7.5%. Market's expecting 8% default rate. That's not going to happen, in my opinion. I think even if it doubles, it goes to 4%, could be a cap appreciation play as well.
Let me ask you a little, I want to drill down on that in a second. Let me ask you a little bit about technology, because the biggest conspicuous loser in the market this month might be the semiconductors. The SOX index is just getting slammed. It's down just this week about 5 or 6%.
It is, and I think that for me, I like that play right now. Third quarter business spending was up 17% over last year. I think business spending is going to outpace consumer spending, and they're going to continue to buy technology. I think it's a nice entry point right now.
It certainly had been, and that thesis you know, has been widely discerned. But I know you have to have a sell discipline as well. So you know, if you lose 5 or 6% in a week and maybe double that in some of the big players in that sector, what is your sell discipline that you apply here, or your buy discipline at the same time? You know,
I like technicals. We like the moving averages. We like the short interest. We like the big money plays. If there's 3 times as much money going in, we're still actively buying. When that breaks down, I'm out. I'll take the losses and move, and we're not seeing it. So I don't think that insiders are selling. I don't think short interest is going through the roof. We're right there on the 50-day moving averages. When all those break down, our processes take us out, and we're still not seeing that right now. Don't like the trade necessarily. It's not fun right now, but I think we'll be proven right.
Now, you mentioned the high yield fund. One of the other popular trades right now, particularly for the individual, is going to be the leverage ETF this morning. I just threw it out there to get Mackie going, but I had mentioned that the ProShares China short fund is having a huge week. It's trying to just blown up. What's your advice on leverage ETFs or ETFs more broadly right now in this market? You
know, we're in the mass affluent market. We're in the game of trying to control volatility. Leverage is great in good times and horrible in bad times, and it's a level of uncertainty that I'm not comfortable with. I think you stay away from the leveraged ETFs. I think that pigs get fat, hogs get slaughtered. You know, you start reaching for that, you'll get slaughtered. I think there's enough opportunity without leveraging up portfolios.
All right, cool. Mark Lamkin, he's the CEO of Lamkin Wealth Management. Appreciate you coming on Breakout.